Welcome back to the Global Ledger. I'm Justin. Over the last few episodes, we've been building a picture of how monetary power actually works. Not in theory or in textbooks, but we've really tried to put this in practice. And we've talked about reserves, standing facilities, and talked about policy tools that don't work the way people think they do. Now, we arrive at a topic that quietly explains why the US dollar dominates the world, even outside the United States. Because here's the truth. Most global dollars are not created in the United States. They're created by global banks operating across borders, inside balance sheets most people never look at. Today's episode is about cross-border banking and how global banks manufacture dollar liquidity without printing, shipping, or exporting a single physical dollar. Let's get into it. Here's the big misunderstanding. When people hear global dollars, they usually imagine one of the two things. Physical cash shipped overseas, or the US government somehow lending dollars to the world. Neither is correct. The global dollar system doesn't run on pallets of cash. It runs on bank balance sheets. A dollar, in practice, is not a thing. It's a liability. And wherever a credible institution can issue dollar-denominated liabilities that are trusted, liquid, and widely accepted, dollars exist. So this is the key idea most people miss, that the dollar's a liability, and any credible institution can issue dollar-denominated liabilities. How is a dollar manufactured outside the United States? Let's walk through just a simple example, okay? Let's assume a European multinational needs dollar funding, okay? Maybe to buy commodities or hedge exposures or even settle international trade. They don't need to go to the US Treasury or even the Federal Reserve. They go to a global bank. That bank creates a dollar-denominated deposit on its balance sheet. On one side, a dollar-denominated asset, loan, trade finance, FX swap claim, and on the other, a dollar-denominated liability. This is the deposit. No physical dollars move. No reserves are required up front. No central bank approval is needed. A dollar is created because the balance sheet expands. This is dollar manufacturing. Why does this work? The system works because of credibility and convertibility, not geography. A dollar deposit at a major global bank is trusted because the bank can access wholesale dollar funding. It can settle through correspondent banks. It can hedge via FX swaps. And it can access liquidity in stress, directly or indirectly. The dollar's power isn't just political, it's infrastructural. Global banks sit at the intersection of trade, capital markets, settlement systems, risk management, and they are the factories of the global dollar system. There's a hidden engine I really want everybody, or I hope to help everybody, or somebody, everybody, somebody understand something, and that is FX swaps. Okay, this would clear a lot of the things like with Argentina and bailouts and all these other things that people get kind of flustered about here in the United States about helping other countries and things like that. But most of the time, this is what they mean. And this is what they're doing. An FX swap, okay? One of the most important tools in this process of global dollar manufacturing is FX swaps. An FX swap allows banks, a bank, to borrow dollars today, lend foreign currency, and agree to basically reverse the transaction later. It's that simple. So from the outside, it looks like a derivative. But in reality, it's temporary dollar creation. FX swaps allow banks to transform foreign currency funding into dollar liquidity at really massive scale. This is why dollar liquidity can expand or contract without a single policy rate change. The market manufactures dollars when it's easy and destroys them when it's not. So why is this system fragile? This is also why the global dollar system is inherently unstable, because these dollars sit outside U.S. regulation, rely on wholesale funding, and depend on continuous market confidence. So when stress hits, FX swap markets seize, balance sheets shrink, dollar liquidity starts to evaporate, and this is how dollar shortages appear without inflation. This is how crises spread even without bank failures. The system isn't fragile because it's poorly designed. It's fragile because it's optimized for efficiency, not resilience. So who really controls global dollars? Here's the reality of this. The U.S. does not fully control the global dollar system. Markets do. Policy can influence conditions. Facilities can backstop stress. But day-to-day dollar creation happens in global banks, dealer balance sheets, FX swap markets, and trade finance networks. This is why global dollar dominance persists even when U.S. policy tightens. The system adapts until it's unable to. And this brings us to the next question. If global banks can manufacture dollars, if dollar liquidity underpins trade, finance, and stability, why would a country not want to use the dollar? Why would governments voluntarily give up control of their own currency? In the next episode, episode 65, we're going to explore dollarization and why countries give up monetary sovereignty. Because once you understand how global dollars are created, you'll understand why, for some countries, resistance isn't practical and sovereignty is a luxury. I want to thank you for listening to episode 64 of the Global Ledger. We talked about cross-border banking and how global banks are able to manufacture dollars. Once again, I'm Justin, and thanks for being here.